G'day, welcome to another training session. I'm going to talk through the way we introduce the investment process. That's the care investment process. I'm going to incorporate two conversations around some of the DALBAR figures and how I use the Andex chart with clients there as well. All done for the same underlying reason, to show clients that we're long-term in the way we think and about what is important and what isn't important. So we're absolutely trying to get the message across that we're not about timing selection. We're about controlling investor behaviour, because the returns investors get are different from the returns investments get. So let's talk about the conversation as I would have it with a client. I say, look, let me tell you how we invest your money. Now, by the way, I'm only talking about this with clients that have a substantial amount of money. For Pathway to Wealth, don't even talk about investments in the first process unless someone asks a specific question in your process. But for your discovery clients that have got 300,000 or more, we're going to introduce that. Let me tell you a bit about how we manage money. We say, firstly, we exclude any direct property, any direct business investments, because they cloud any asset allocation and they're very much driven on personal preference and personal risk profiles. In other words, if you've got a client that's got 4 investment properties, as well as the funds you're going to look after as part of the care process, don't put it into an asset allocation. Our industry's done that in the past, and what does it say? You've got too much property. That's a problem most people want to have, so it's not something you should ever say to someone. You just say, look, if it's appropriate for them to keep that property, just exclude it from the asset allocation conversation. So then say, look, we break your investments down into 4 buckets, and we use an acronym called CARE to describe that. Our investment process is as much a communication process as it is an investment methodology, because the bad behaviour is often driven by a breakdown in communication with their advisors, where they're not sure why they had the investments in the first place. The care process works, and it's worked through market cycles, because clients know exactly why they've got each element in the bucket. So the first thing stands for, as you know, it's your core investment. So it's a multi-sector, multi-manager, or multi-sector index, depending on what your preference is. It's the whole world. So, and we hold that through the good, the bad, the ups and the downs. And, you know, the only time we would change that is when we get a better way to acquire that. But we tend to use multi-manager or index and adjust that line to what you're actually using in your implementation. And we say, look, the challenge we've got, for most people this would be fine, but the challenge we've got for most people is they don't behave properly. The average holding time for a mutual fund in the States, 3.2 years. I suspect Australia, not much difference, although we don't have very good statistics, because most people don't behave well. So the other areas that we've introduced are to compensate for that. First one is the reserves. So if you're a retiree, we keep 4 years worth of liquidity in cash and term deposits. So in other words, fairly risk-free investments. So that means we know we don't have to sell any of the good stuff when times are bad. The only way people can lose money in the property and share market, if they're well diversified and well selected, is if they have to sell or they panic and sell. It's our job as advisors to make sure they never do either. So the reserves is pretty easy to explain. Let's say we've got someone with $1 million, and that might be their target, by the way. Just an aside, if you're showing someone why you manage money, they've only got 300,000, but you know their goal is to 2 million, show them how you're going to manage it at 2 million. Because it's just more relevant in terms of what you're building over the process. But let's say we've got $1 million and someone's going to pull out 60,000 a year. So straight away the reserves, 60 times 4, 240,000 into that. Now that's topped up when markets are up. So we'll sell off some of the rest to top them down, and it's let run when markets are down. So it provides the buffer for those people to get through the inevitable and certain volatility that the rest of the markets will bring. Now, in terms of the others, they come out that bad behaviour, and the way we used to explain that is around the DALBAR studies. So the DALBAR study, we'll ask a client, look, have you heard about the study called DALBAR in the States, which talks about the returns investors get compared to what investments get. Now, I know that sounds funny, but they're not the same thing. So initially, the first time I saw this was in 2004. At that stage, the S&P, which is the US equivalent of the All Ordinaries Index, sort of, had a 20-year long-term record of 11.5%. Now, we'd think that's what investors would get, wouldn't it? But what do you reckon investors got over that same 20-year period? Now, the answer is 3.5%. So investors lost roughly 8% by what? Their own behaviour, not by what the market did. If they just bought it and held it, they would have got 11.5%. They lost it through their own behaviour, whether that was self-directed or driven by advisors. So what did they do? They got excited when it got up and they bought too much of the wrong stuff or geared into the wrong stuff. They panicked when it went down and they got out of the good stuff. Now, to use an exaggeration, I use an example of the tech wreck or the 80s boom. In the 80s in Australia, we had a boom in entrepreneurial and gold stocks. So 1987, and I'm now pointing at the Andex chart, which I use in every conversation about investments. So this just jumps from here, I scribble on a whiteboard, straight into the real world. So I say, explain to the clients that, yes, this is a chart that shows the value of $100 back in 1950 through to, well, this chart goes to the end of 2011. Blue line being the share market, red line being inflation. Just always a good idea to remind them, cost of living up 24 times in that period. It's going to go up 3 to 5 times in the average retirement. So that's their biggest enemy. Term deposits won't do it, bonds won't do it. We've got the light blue line of a balanced fund and the dark blue line of a growth fund. Most of our clients, if well advised, are going to end up somewhere in there. So I say, what happens at these extremes? Well, during the 80s was a good example. We had gold and entrepreneurial group. So that was Bondi, Scasey, all those guys. There's always an era of this time it's different, and it always isn't. Eventually that goes up. Now the market dropped close to 50% that time. But people that had focused their portfolio on that single idea of the gold and the entrepreneurs lost 90 to 95%. Same again in the tech wreck in the States. The market itself down 50%, but the NASDAQ index down 90%, and some companies gone completely. So our job is to keep you invested pretty much on the blue line, which is what this first bit does. Now the active segment, which is the next segment, does exactly the opposite of what most people do. So most people panic and get out, get excited and get in, or worse, gear up or single focus, panic and get out, gear up or single focus, and that's what wipes out the 8% or more for them over that cycle. Long term, the markets are pretty straightforward. So what we do in the active segment is we break out 5 key sectors: Aussie shares, global shares, emerging markets, small companies and gold. You can have slight variations on this depending on how you implement the care process, but that's how I use it. So we implement this through either single sector funds or ETFs. I use ETFs, so I'd say ETFs. And we're happy to own those fully, but we're also happy to go back to cash at a certain time in the cycle. Now it's not done very complicated, it's not done to be trading, it's a medium-term smoothing technique which says we're happy to be fully invested when the markets are below their long-term averages, but we're happy to take a holiday and take a profit out of this section when they're above their long-term averages. So that's going to be an every 3 to 5 year sort of swing. So that active segment, if you punch these into your care calculator in the, off the website, you'll get the percentage from out of here by the time you put in their reserves numbers. But let's say we've got a growth investor, and by the time we exclude that, we've got about 760, and I think it's roughly a third in each. So I'm going to do the maths quickly. 760, we've got 250 something in each of them. You can tell I shoot these, having worked these all out in advance. I don't. I talk exactly as I do with the client when I'm making these videos, so they're generally done in one shot. So it's about 250 something. You get the gist. It adds up to $1 million. We'll cheap make that 250 for today. So that gives us the buckets. So this can go to cash when times are running hot, and back to the investments when times are down. And lastly, the enhanced portfolio, which can be where you can add your opinion to the world. I use a simple share portfolio. In there, you can use a high alpha fund. So once again, this is the excitement, this is the interesting stuff. This is deliberately designed to be boring, to get you, the client, the blue line. Whether that's the high growth or the balanced fund, but simply to get the blue line. This is to make sure we're doing something as the market goes through its inevitables, because the client, you want us to do something. If we say just hold, 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 you get frustrated and you make some of those big mistakes we've talked about. So definitely, so this smooths the opposite. This fills up the cupboard, ready for a long winter, which is the analogy we use with the clients. So we've really got probably 7 to 10 years in here, because you've got the dividends and the distributions from the other buckets coming into here as well. So by the time you allow for that coming in, you've probably got 7 to 10 years worth of cash flow. So that means the client should never have to sell unless they haven't planned their expenses properly. And with our understanding and explanations of the market, through the Andex charts and an understanding of the Nick Murray type stuff that we talk about, they'll never panic and sell. So if they never have to sell, they never panic and sell, we can pretty much plug in the percentages inflation plus on the Andex charts for their planning, which allows us to do a plan. Good luck, have fun with it, thanks.